Welcome back to the Free Forum Project. Today, we're diving into one of the most significant events in financial history, the 1929 stock market crash. But we're not just here to talk about the past. We're here to uncover the valuable lessons that can help us navigate today's financial landscape. So, let's get started. The Wall Street crash of 1929, often called the Great Crash, marked the start of the Great Depression. This is more important to keep in mind now, more than ever, as we are teetering on the edge of epic inflation, interest rates, investor uncertainty and regular downward trends in financial markets. The Great Crash was a catastrophic event that saw the stock market lose nearly 90% of its value over a few short years, wiping out fortunes and devastating the economy. Lesson 1. Speculation. The 1920s were marked by rampant speculation. People were buying stocks on margin, essentially borrowing money to invest. When the market started to decline, these investors were forced to sell, exacerbating the crash. The lesson here is the danger of excessive speculation. Always know what you can afford to invest. Don't overextend yourself to speculate, or bet, on the market. Far too often people miss the blatant fact that most investments are made in an effort to get rich quick when that's not what the markets were intended for. This means people are risking their life savings on a whim, and the results can be devastating. Lesson 2. Diversification. Back then, many investors put all their money into just a few stocks. When those stocks crashed, they lost everything. Diversifying your investments across different asset classes can help protect your portfolio. This is why it's so important to ensure that you aren't putting all your eggs in one basket. Relatively few people actually make money on trends and gimmicks. Just because something looks attractive, short-term, doesn't make it a sound investment. Any responsible financial expert will tell you that you should have a healthy balance of investment vehicles. Lesson 3. Emotional investing. The panic and fear that gripped investors in 1929 led to impulsive selling. Emotions can cloud judgment. Having a well-thought-out investment strategy and sticking to it can help you avoid making decisions based on fear or greed. This is the prime reason our channel made content regarding the bank failure months ago, when SVB was plundered and failed. Many people feared a run on the banks, just the same as when the Depression was gearing up and in full swing. Reacting to emotional motivators can cause severe damage, not just to you personally, but to everyone else that has investments tied to the market as well. Concepts often discussed in investment arenas revolve around this. Many times, investors react in the opposite way of what would create wealth. The truth of investing is to buy low and sell high. While this sounds basic and simple, many people fall victim of doing the exact opposite. Psychologically speaking, we feel more comfortable when stocks are doing well. We see the investments in the green and feel good about buying. Sometimes this can pay off, if the stocks continue to grow, but they may not. If the stock has already grown in value, and you invest because of how much it's grown, you've already missed the opportunity in most cases. You should be buying before the growth starts, and then selling when it hits that higher value. You also have the phenomenon of selling when a stock hits rock bottom, because investors panic. You don't fully realize your loss until you sell for less than where you bought. There are circumstances that this has to happen, cash out, so to speak, so that you can move on and try something else. But when it comes to life savings, you have to steel your resolve and wait. Lesson 4. Regulatory reforms. In response to the crash, significant financial regulations were put in place, including the Glass-Steagall Act and the creation of the SEC. These reforms were designed to prevent excessive speculation and promote market stability. Just keep that in mind as we move forward. We are likely to see more changes in the regulatory environment as this crisis continues to loom, and when we do inevitably exit from it. We need to be aware and cautious as investors and voters, understanding what they will seek to change and how it will impact us. As a side note to this topic, consider the legislation being talked about now, which will benefit huge corporations and could possibly eliminate credit card rewards for consumers. If you aren't familiar, you should head over to the website, Hands Off My Rewards, and check it out. We should all be fighting to dismantle this proposal that will hurt consumers. Lesson 5. Long-term perspective. While the crash and the Great Depression were devastating, those who stayed invested eventually recovered their losses. This underscores the importance of a long-term perspective in investing. The markets are cyclical. The only true factor is time. If you are in a position that you don't need to tap into your life savings anytime soon, leave your funds responsibly invested and wait until the market cycles back up again. When that happens, the losses you never realized will be wiped away and they can become gains again. In conclusion, The 1929 stock market crash was a painful chapter in history, but it offers invaluable lessons for today's investors. Avoid excessive speculation, diversify your portfolio, don't let emotions dictate your decisions, and appreciate the importance of regulatory safeguards. And always remember, a long-term perspective can help you weather even the toughest storms. Thanks for joining us today. If you found this video informative, please give it a like and subscribe to our channel, and share it with others. By learning from history, we can become better, more informed investors. Stay tuned for more insights on finance and investing. As always, think freely. Discuss openly.